Imagine you are Maria, an ailing woman with a house in New Jersey and children in Florida. What would you do? Maria's health is declining, and she's longing to move closer to her kids down in the Sunshine State. She's sitting on $400,000 in home equity, but how can she leverage that to make her wish a reality? For Maria, a home equity conversion mortgage, or HECM, could be an excellent solution, but how does it work? Firstly, Maria would need to qualify for a reverse mortgage. Being over 62 with substantial equity in her home, she likely meets the criteria. To confirm her eligibility, she would undergo an assessment. This involves evaluating her age, the value of her home, and the amount of equity she has. The Federal Housing Administration, or FHA, provides clear guidelines for this. Now, it's not just about ticking the eligibility boxes. Maria must fully comprehend what a home equity conversion mortgage, or HECM, entails. It's a significant financial decision after all. So, she would need to attend a counseling session. This session is designed to provide a complete understanding of the HECM. It covers the implications, obligations, costs, and benefits associated with a reverse mortgage. Armed with this knowledge, Maria can make an informed decision. She will know what she's getting into and how it can help her achieve her goal of moving closer to her children. Once Maria understands the ins and outs of HECM, she can move forward with the process. The FHA will appraise Maria's current home to determine its value and the amount of equity available to her. This appraisal process is crucial, as it measures the market value of the home, which is the price a willing buyer would pay to a willing seller in a free market. This is done by a professional appraiser who looks at several factors including the condition of the home, its location, and comparison to similar homes recently sold in the area. Once the appraisal is complete, the appraiser will provide an estimated value of the home. Now let's talk about equity. Equity is the difference between the value of the home and any outstanding mortgage balance or other liens. In Maria's case, she has an impressive $400,000 in equity. This equity forms the basis of the loan amount Maria can get from the reverse mortgage. The loan amount would be a percentage of the home's value based on Maria's age and current interest rates. With $400,000 in equity, Maria can use a significant portion of it towards her new home purchase. Maria could opt for a HECM for purchase loan. This type of loan allows her to combine the proceeds of the reverse mortgage with the sale proceeds of her current home to buy a new home. Now, how does this process work? First, Maria will apply for the HECM for purchase loan, just like she would for a traditional mortgage. She needs to meet with a counselor approved by the Department of Housing and Urban Development to understand the details and obligations of her loan. Next, the Federal Housing Administration will appraise her current home to determine its value and the amount of equity she can tap into. Once the loan is approved, Maria can use the proceeds towards buying her new home in Florida. However, it's important to note that the new home must be her primary residence. She cannot use this loan to buy a vacation home or an investment property. Maria would use the reverse mortgage funds as a down payment on the new home in Florida. With a HECM, Maria won't have to make monthly mortgage payments. Instead, the loan balance increases over time as interest and fees accrue. This means her equity, that is the part of her home she truly owns, decreases. It's a trade-off, a way of using the value tied up in her home to provide a secure and comfortable life closer to her children. Now let's look at when the loan becomes due. If Maria decides to sell her home, move out permanently, or in the unfortunate event of her passing, that's when the loan needs to be repaid. Typically, the repayment is made from the proceeds of the home sale. So, while Maria lives in her new home, she doesn't have to worry about monthly mortgage payments. But she does need to keep up with property taxes, homeowners insurance, and maintaining the property. These are crucial responsibilities that come with a HECM. But here's the thing. This is not a decision to be made lightly. It's a significant financial commitment with long-term implications. That's why it's crucial for Maria to consult with a real estate agent experienced in HECM transactions, as well as a financial advisor and/or attorney specializing in elder law. By leveraging the equity in her current home through a HECM for purchase loan, Maria can move closer to her loved ones while feeling more secure about her living situation. But like all good things in life, it comes with its own set of responsibilities and considerations.